Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
We're going to go next to Carmen Reinicke. She is a Bloomberg News equities reporter here with us, and she's going to talk about Super Microcomputer. Oh my gosh, that stock has been on a wild ride. What are you watching?
It has had an absolutely crazy week. I was just looking, shares right now are up about 11%. This is on track to gain more than 75% this week, which is the best week ever for this stock, which has also just had a completely crazy up and down year. So what happened this week is on Monday, the company, which had fallen out of compliance for listing on the NASDAQ, submitted to the NASDAQ a plan to regain compliance, which means filing some delayed 10Ks and 10Qs. It also announced that it has a new auditor, BDO USA. And I think this is really the piece that people were excited about and that traders are trading on, because this is it just means that it'll be easier for the company to actually file those filings and get back into compliance to stay listed on the NASDAQ.
The fact that they actually found someone who agreed to testify that their numbers aren't fraudulent. Like, if that's the bar, it's pretty low, right? So
Yeah, well, and that's the thing. I mean, this is a company that's burned through a few auditors in the past few years. It's one of the reasons that it delayed filing its 10K was a short seller report from Hindenburg Research came out sort of calling into question some accounting. Ernst & Young, its previous auditor, stepped down in October, citing issues with governance and transparency. So yeah, finding a new auditor is a big deal. And it kind of remains to be seen what exactly, what will happen next. The NASDAQ still hasn't accepted Supermicro's plan, so they've filed. They said, we have a plan to stay compliant. The NASDAQ now has to say yes or no to that. It's assumed that it'll take 2 to 5 weeks for anything to come out on that. And then if the NASDAQ does accept the plan, it has until February to file these reports, which, as I've reported this out, seems like is not the easiest lift, right? Like this is still sort of a truncated timeline to potentially, deal with these kinds of issues. Still, that being said, some analysts seem to think that this really has removed an overhang from the stock. And as we can see, more buyers than sellers today.
So what would happen to Supermicro if it was delisted from the NASDAQ?
Yeah, so I mean, it would be taken off the exchange. It would go over the counter. It would also be removed from the NASDAQ 100 and the S&P 500, which it just joined this year. So that's a huge deal. Obviously, it would mean a big rebalance for a lot of people, and yeah, a lot of trading.
It's pretty amazing. I mean, it's still a $20 billion company. And if your auditor, one of the most respected auditors in the world, says, peace out, like we can't have our names even associated with your books, that should be a black mark, right? But if you look over the last 5 years, I always default to 5 years because I use the comp function a lot on the Bloomberg. The stock is up 1,471%.
It has had an incredible run. It's obviously gotten a huge lift from the AI wave. It's sort of seen as a trading peer, at least, to NVIDIA, and it actually got a shout out this week on NVIDIA's earnings call. NVIDIA said, this is one of our most reliable partners. And so, yeah, we've seen this stock really, really take off.
What is the precedence for companies being delisted? Like, have we ever seen a company then return after a delisting and come back to the exchange?
Question. I mean, companies do get delisted. Supermicro itself has previously been delisted and come back onto the exchange. So yes, that's certainly something that happens. I don't know of an instance where a company has done it twice. But yeah, it's definitely something that happens.
We'll have to look into that, Matt.
Actually, I was just starting to look into it. I'm typing away on
doing some research over here.
One of the things I did was pull up SPLC, which is one of my favorite functions on the terminal. For a company like this especially, it shows you the supply chain, and you can see their biggest suppliers, NVIDIA, right at the top of that list, their biggest customers. I know Big Blue is one of those, which, back in my day, IBM was the most reputable tech company. Obviously, it's dropped a little bit in terms of its size and weight, but still is a company that people know and certainly trust. SMCI. I guess their earnings hasn't really been slowed down by the change from EY to BDO.
I think it's too early to really say. So they did, maybe a few weeks ago at this point, give sort of an update. They called it a business update. It was essentially an earnings report. And they gave, I think, a little bit of a weaker forecast than people had expected. So shares were actually sort of under pressure from that, if I remember correctly.
I should say the revenue has just been soaring, right? If you look back in
exactly.
2020, they were making like $3 billion in revenue. And now we're talking about 25, just 4 years later. Carmen, great having you here with us. Thanks so much for joining us in the Bloomberg Businessweek studio. Carmen Reinicke there from our print team. Matt Miller here with Emily Grafeo, filling in for Tim and Carol on this Friday. We'll be back in just a moment with the CFO of Home Depot. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Matt Miller here in the Bloomberg Businessweek studio with Emily Grafeo. And we have a special guest, as I said, the CFO of Home Depot joins us, Richard McPhail, as well as Nina Trentmann. She runs the Bloomberg CFO Briefing, so it's great to have both of you with us. And I guess I'll just kick it off with one to Richard as we kind of gauge the strength of the U.S. consumer and the housing market. You're in a perfect position to give us an outlook on both. How do we look, 4 days ahead of Black Friday?
Well, Matt and Emily and Nina, thank you for having me. So, look, as we've said now for the last year or two, the U.S. consumer remains healthy and strong and engaged in home improvement. We had a third quarter that just ended in October where we actually saw performance better than expected. Now, we attribute most of that to the fact that weather was exceptional across the country. We also had some impact from hurricanes, obviously. But, it's a good sign when the sun is out, our customers are engaged and outdoors doing projects. So we think the customer mindset is healthy. Now, you ask about the state of housing. There is some interplay here with home improvement. If you think about the last 5 years, since 2019, we've seen unprecedented increases in home values and home equity. Home values up right around 50% since 2019. Home equity positions up right around 80%. And so you've seen unprecedented wealth creation in housing. What's interesting about that is typically that drives home improvement demand and home improvement spend as homeowners invest in their homes. What our customers tell us, though, is that the interest rate environment is still sticky. We actually saw mortgage rates increase since the September Fed meeting, so that's led to a disincentive for folks to move and do projects that are oriented with moving. And if you think about those larger remodeling projects that are oftentimes financed by debt drawn against home equity positions, our customers tell us while those rates are decreasing slightly, they're still around 8.25% to 8.5%. And so they're saying, look, we're deferring large projects for the moment until we see what happens with rates. So you have a healthy customer with a deferral mindset when it comes to larger projects.
Richard, maybe I can follow up on that. During our interview, we also talked about the impact of your business potentially stemming from tariffs as the new administration comes in next year. Talk to us a little bit about that, how you navigated that in 2019, and also how you're thinking about that going into next year.
Sure. Well, first, it's too early to speculate on what the administration might be thinking here. So we don't want to speculate on particulars. In 2017, we saw tariffs of significant degree in certain classes of goods. There were some appliances classes that saw tariffs upwards of 25%. Look, that's something that we sit down with our supplier base and work through. And so we've got a lot of experience in this, and we are ready for whatever environment we're going to be operating in. Again, too early to speculate, but we feel like if there's anybody who can manage through this, we can. And unique to the Home Depot, perhaps over half of our products are actually manufactured in the United States. And so if you think about the kind of the less than half that is manufactured or sourced from foreign countries, we've been diversifying our countries of origin really for the last 15 years. We're in a different position than we were in 2017 with respect to diversification. That's something we're going to continue.
So, Richard, I'm wondering, what is the strategy to grow the business right now when we're in an environment where home sales are at the lowest level in over a decade? How does Home Depot kind of combat that?
Well, Emily, there's so much improvement we can make in our current model. We have the fifth largest e-commerce business in the United States, even though folks don't normally think about that. But the uniqueness of that business is it is interconnected with our stores. Virtually all of our customers who shop online shop in our stores as well. But there are too many points of friction when you think about customer returns, order modifications, and the delivery experience. We're making huge gains in taking friction out of the process for our customer, but we're nowhere near where we want to be. We know if we begin to delight customers more, that absolutely translates into higher sales. Another huge opportunity for the Home Depot is with the professional contractor. Roughly half of our sales come from that professional contractor who's working on behalf of the homeowner. We've made significant investments in an ecosystem to really drive into that larger remodel. And so while the market is soft for remodeling, our ability to capture market share really shouldn't depend on what the external environment is. We've invested in a digital experience, in rolling out a sales force across the nation, and fulfillment assets and capabilities, networks of flatbed distribution centers that'll be in 17 markets this year, where we can get product straight to the job site, not even touching the store, straight to the job site, same day, next day. And the uniqueness of Home Depot is, while there are plenty of companies serving the pro like that, we're the only one who can serve them across all product categories. So we can simplify the pros' lives, and they turn to us because they know that they can rely on us. And I should say, actually, Emily, one thing that I think is unique to the Home Depot, we're building stores again. We really stopped in any material sense building stores in 2008. In 2023, we announced an 80-store build that will roll out over 5 years. By the end of this year, we will have built 25 of those new stores. And we're so excited about what we're already seeing. It's one of the best investments we can actually make at Home Depot.
All right, Richard, great to have a little bit of time with you, and I hope we can get you back either here on Bloomberg Businessweek or join me on my show every day, 9 to 11 on Bloomberg Open Interest. David McPhail there, the CFO of Home Depot. Sorry, Nina, I'm kind of stealing your guess here.
Yes, you're stealing my thunder.
You have a lot of it, so there's enough to go around. You talked to a lot of important CFOs for the CFO briefing. One of them recently, CFO of Saudi Aramco, and what did he have to say?
Yeah, so that was earlier this week in Boston. I got to catch up with him there. We covered quite a range of topics, sort of ranging from their dividend spending, debt financing plans, CapEx. So yeah, I was quite pleased to secure that interview. Amongst the things that we talked about was their plans to spend over $120 billion this year on dividends, which is of course a mind-boggling number. There is a lot of talk around sort of how much Saudi Aramco will keep spending on dividends going forward. I think the main point there is that they have a performance-led portion of that dividend, which they implemented in starting last year, when basically they realized, okay, we're generating a lot of returns from high energy prices following the invasion of Ukraine through Russia. This performance-led portion will be reset at the end of this year, and the question is very much, okay, well, what will this company be spending on dividends going forward? Because they moved from having a lot of surplus cash into actually moving into a net debt position at the end of the past quarter, and so there's been a lot of questions around that the CFO received.
Yeah, very interesting stuff. And I know he is an MIT alum. He was there in Boston giving a speech, and some protesters made such a racket that he actually had to leave the event and not come back. You can see all of that and more in Nina's CEO briefing.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, holiday season quickly approaching, and we want to get our finger on the pulse of the consumer. To do that, we go over to Katie Thomas. She's from the Kearney Consumer Institute. They've recently done a study of 14,000 shoppers. She joins us from Pittsburgh, in the middle of America, where the normal people live. Katie, thanks so much for joining us. How do the normal people feel right now?
The normal people are actually feeling okay. Going into the holiday season, there's a lot of optimism. Even talking to folks post-election, people are surprisingly willing to spend. They say they're feeling better about the economy, or conversely, they're participating in some retail therapy. They're concerned tariff prices will drive up the cost of electronics and other items. So I'm anticipating a healthy holiday season, even though it's a little bit shortened given the late Thanksgiving timing. Like you guys said, Black Friday sales have been going on for weeks already. So I think we're going to have a strong season.
And what are these consumers buying? Are they going to the big ticket items, or are they being a little bit choosier and just finding maybe smaller luxuries?
Yeah, I think right now we're seeing people still feel pretty thoughtful. I think we saw this in the last couple of weeks with earnings, right? Walmart coming through with really strong price value, and that's what you're seeing with consumers in general. And that starts to tie into some of the work that we just wrapped up around tensions consumers are facing. So you see them wanting to spend. People love to spend around the holiday, but they do still have these lingering concerns around how their wallet looks, and they don't want to overspend and start the year off on the wrong foot.
Yeah, I don't love to spend around the holiday. I just feel like I have no choice, right? I mean, you got to buy people presents, you got to get plane tickets, you got to hire more staff or whatever. I mean, I don't have staff.
What
No,
are you
I don't know. I'm just trying
for?
to think of the things that you might want to be spending money on for the holidays. Are people feeling like their wages have really kept up with inflation? Because it seems to me I get one answer from one economist and a different answer from another. So, how are we doing in terms of keeping up with higher prices?
Yeah, I mean, I think objectively speaking, when you look at data rolled up, that is what you see, Matt, that technically wages are outpacing inflation. But to your exact point, we run some analytics with what we call the Consumer Stress Index, and we have seen a slow uptick in concerns around cost of living, as well as concerns about personal job security, which is a little bit concerning, even though you're not seeing that much in the employment and job growth numbers right now. People feeling concerned that if they lost their job, they may not be able to find one, or that they could lose their job. That could be something meaningful that drives kind of a pullback in spend and a resistance to spend. But when it comes specifically to the holidays, people do typically like to spend on gifts and on gifts for themselves. And then what you'll see is a bit of a slowdown in the new year.
You mentioned demographics in the notes that you sent over, and I'm wondering what your research is showing about just how different demographics are spending and how they act as a consumer. I imagine the Gen Zs are getting a lot of their favorite brands from TikTok and social media, and I'm wondering if that kind of spans across all ages now.
We're certainly seeing a pickup there. One of the things we see, though, is it's hard to slice just by demographics alone. So we ask consumers in our work, for instance, one question is, are you living paycheck to paycheck? And we, like 2 out of 3 consumers actually say yes. It's self-reported, so that could mean a lot of different things. But when we split that into paycheck to paycheck and then living within means, we actually see a lot more similarities there in terms of behaviors and stressors than if we cut by just income alone. So we are seeing people kind of, it depends a little bit on more of those attitudinal psychographics. So not necessarily Gen Z on TikTok, but just your likelihood to be engaging on a social media platform. Matt, to your point at the top, there are folks across the country who are not all that engaged or all that online as some of the rest of us are. So it really kind of depends on what your media consumption looks like.
Oh, they're so lucky. You know what? Speaking of psychographic, I noticed this sentence in the survey. packet. Just in time for the holidays, this nuanced meta-economic and psychographic view is based on a unique set of macroeconomic data and proprietary KCI research. Are you sure you're in Pittsburgh? Because I don't know what that means.
I don't think those are the notes I sent over, so I'm going to have to. That's a lot of a bit of a word salad there, Matt. But I think
what do you mean when you say psychographic?
Well, it's just really capturing the lifestyle of a consumer. So this research was really grounded in the fact that consumers have continued to see this proliferation of choice. You guys were actually talking about it with the mattresses. We have more options than ever, more access to information than ever. And then we tend to get lost in this narrative that consumers are increasingly demanding more and more options, when in fact, in most categories, consumers are overwhelmed by what's out there or simply satisfied. They don't feel like they need this constant influx of options. So the psychographics there are what really it's the devil's in the details. We have to understand the push-pull dynamic that's happening there within consumers and between consumers and brands.
So how does a brand kind of build success off of that? Because I mean, yeah, the mattresses, ultimately it came down to there was an avocado store around where I was. I laid on the mattress. I was like, this is good. I don't want to think about this anymore because there are so many options. So how does a brand figure out how to stand out?
Yeah, well, Emily, I think it's just that. So it's thinking, we like to sometimes call it relevant choice rather than more or less choice. It comes down to portfolio strategy, growth strategy, innovation planning, and like if brands are really innovating for the right reason. So you think, for instance, of grocery. Sometimes innovation happens simply so they can hold a place on shelf. When you think of, any kind of mall retailer, it's just like a classic merchandising calendar and just this continued churn, or perhaps sometimes it's in response to competition. It's really starting to ask tougher questions there of, do we need these additional options? Do we need to cause more confusion? Do we really like, for instance, yogurt? Yogurt has over 300 SKUs on most shelves, but the most popular flavors have been the same 5 for the last 50 years. So even though some new flavors are nice, it's just really finding the right balance.
Key lime pie. That's one of those 5, right?
That one's good.
I'm not sure.
Katie, thanks so much for joining us. Always a pleasure talking to you and hearing from the Kearney Consumer Institute. Katie Thomas there out of Pittsburgh talking to us about how consumers in the U.S. are feeling this holiday season. Avocado is a brand I had never heard of before. I thought I was being pretty new and, young and fashionable with Satva, but what is avocado?
I actually hadn't heard of it either, but I was in Williamsburg and they had a store. You're gonna hate this. So they had kombucha and cold brew on tap, complimentary for the customers in the store. It
almost seems like it's a joke. In Williamsburg, there's a mattress vendor called Avocado that has kombucha and cold brew in the store.
Their pitch, I don't know that much about the mattress, but I ultimately bought it again because I laid on it. It was comfortable. I needed a mattress. I didn't want to think about it. But they have a green pitch as well. They talk about how their mattress is more environmentally friendly.
It's so sustainable.
Yeah.
That's good. So you feel good about yourself as you're sleeping on it.
That pitch didn't allure me in as much as just I need a mattress, and this is here.
All right. I need some tires. So if you see anybody with Continental Extreme Contact DSW 6 Plus tires on sale, I need a set of 4 of those for my Dodge Challenger, which is not at all sustainable.
I don't think they have kombucha at tire shops.
4-liter V8. No, definitely not. Just cold black coffee. When we come back, we'll talk to Jenny Rooke from the Genoa Ventures firm about strategies for investing in early-stage, high-growth companies.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We're joined now by Jenny Rooke, founder and managing director of Genoa Ventures. She's here in the Bloomberg Interactive Brokers studio, usually in San Francisco, but here today in New York. Before we get to the companies and the investments that you're doing right now, because Genoa focuses on biotech and healthcare, what's your background?
I'm a scientist at heart. I was studying physics and software engineering when I fell in love with genetics, went and got my PhD there. And so I really am excited about how those things are coming together, those technologies and biology. And then I've spent a career trying to figure out how to put that to work.
All right, so Wall Street, I guess, is the one place that you could go to try and put that to work.
Indeed.
Did you hit that street before Sand Hill Road?
Not really. No, I walked through first. I guess my closest path to Wall Street was really consulting to very large pharma companies. I spent some time at McKinsey. It was a great way to get familiar with what the big strategy questions were to the companies that matter to Wall Street. And so that's great perspective in working with startups to think about how they're going to bring innovation to Wall Street eventually.
And is there a more specific theme than biotech, healthcare? I mean, I know that you funded, for example, 2 female Nobel laureates.
So far, yeah, we're trying to keep funding the great Nobel laureates. Yes,
keep more.
1 per fund is my goal.
But the reason I think it's interesting is that I know some crazy small figure, like only 2% of total VC funding goes to women. So the fact that you've funded 2 already puts you kind of ahead of the pack.
By far, I think, yes. Yeah, we're proud of that. I think it comes down to just looking at the fundamentals and really asking what are the needs in healthcare and beyond, and how do the innovations that are happening in the laboratory address those needs, and really understanding what's happening at the fundamental level.
Okay, so tell us about some of the companies right now that you're invested in that you're currently excited about.
Yeah, well, so we're excited at companies that are bringing together biology and technology in untraditional ways. And so often they bring together founders who, some might be coming from healthcare, but you might have a collaborator coming from electrical engineering or data sciences, and really mushing those together in new ways. A great example is a company called Epitel. They are really bringing innovations to how we detect and monitor seizures. If you've ever seen anyone try to get an EEG with a bunch of wires and leads coming off of their heads, it's a little bit difficult to bring that into people's everyday lives. So what Epitel is doing is making a small wearable version of a detector that patients can wear in the hospital, moving around, even in their home eventually, which really changes how we can help those people.
So you can monitor, I'm guessing that comes from epilepsy,
Correct.
Epitel, and you can monitor how often the seizures are, how serious they are, when they occur,
Correct.
and so on and so forth, and try and help those people live better lives?
Yeah, and I think it's an extension of things that we all know well, which is continuous monitoring, whether you've got an iPhone or an Apple Watch or an Oura Ring, like these ideas of the more data you can collect continuously for a person, the more information you can give people to make better choices.
I'm thinking about an Oura Ring for Christmas, asking Santa.
You're considering?
Yeah, just as an aside.
My wife loves her Oura Ring, and she constantly tells me when it's my turn to take care of the kids because she hasn't gotten
the Oura Ring.
Yeah.
Better choices for everyone.
That's right.
Driven by better data.
AI is a theme that we've all been focused on as well. I know Emily recently was at a conference and talking about VC. I was recently at a conference talking about AI. And you're, I guess, investing in AI as well. I see it mentioned for Symbiosis, which is a company that you've invested in. It's a treatment support tool for women with breast cancer?
Yeah, the category is called clinical decision support. It's providing clinicians, physicians with better tools to make better decisions for patients and patient care. And that's more and more important these days when we have a profusion of different types of, say, drugs and interventions. How do you make the best decision for each person with more and more information? And so the AI is a way to, as you know from other fields, combine different kinds of information of different sorts and sources into a single unified view. And so that's increasingly important to patient care as well.
How are you seeing AI being used in healthcare? Is it more just a tool to help professionals? Because I have to admit, I went to a doctor and there was an AI, I guess it wasn't a robot, but it was a phone that he held up and it was taking notes.
Yeah.
But I've also heard about, AI being used as a diagnostic tool, reading MRI images. What are some of the surprising ways that AI is being applied into healthcare that excite you?
Yeah, well, so you gave some great examples, and so that's at the delivery of healthcare end. But way up at the beginning, where scientists are looking for new insights, AI is helping them in a similar way pull together a bunch of different information about the science they're studying, come up with new insights, and ask the next question. So it's accelerating the pace of basic research that gives rise to all these innovations that eventually show up in the healthcare setting.
So going through basically mountains of data that would take you and your team probably months or years, and AI can do that in a matter of hours or days.
Yeah, and it's bringing all that together in a way and helping us visualize it also in ways that are novel, so you can kind of poke and prod at it from different directions and come up with new insights, which is what's so critical for science.
So when you find these companies or these founders and decide that you want to invest in them, how much further do you take it? I mean, do you work with them to do other things that are necessary that maybe they wouldn't be good at as scientists, since you have a consulting background? Do you find people to help them do the kind of back end stuff that a lot of us can't do? I mean, how far along do you hold their hand?
Yeah, I really appreciate this question. Genoa was born because I'm also an ex-startup operator, so is everybody on our team. We love building these kinds of companies and helping other people build these kinds of companies. So we're builders for builders. And as you can imagine, the kinds of innovators who may come up with the latest thing in AI for bio may not also know about cap tables or preference stacks in the startup setting in ventures. So we like to bring that knowledge to them to help them on their way as well.
How do you think about valuations right now?
Very carefully, I think, is the answer. Yeah, I think obviously it's been a tough couple of years in the markets, which is having an impact on valuations up and down the stack. But I think probably a pretty healthy reset. Things did get a little out of control, in 2020, 21.
But is that because SVB collapsed, or because everybody would rather invest in NVIDIA?
Well, it's a multifactorial, right?
No, I mean, what's made it tough? Because I've heard that also from other VCs, and I've heard my friend Jesse Draper from Halogen talks about a recession, and I'm like, what recession?
It's fine,
But a lot of businesses I know are feeling it.
Mm-hmm. Well, I think you do get this kind of circular situation where investors are working very closely with the companies in their portfolio, helping them through a tough time. Even just the bandwidth to look at the next thing, much less the capital, is a little bit lacking. But as I think the macros start to trend positive, we're starting to see signs of things moving around a little bit. Liquidity is the word on everyone's lips. We really need to see some of the big exits in companies that have stayed private quite a lot longer. As the IPO window opens up, as we see more acquisitions, we think that moves through the whole stack.
But I imagine in this sector, I just look at the companies that you are investing in, and I think, why doesn't Apple just buy that? So it doesn't have to be an IPO.
No, it doesn't. And historically in bio, most of the exits were predominantly in M&A. You have really market leaders in each of these different bio segments, whether it's healthcare, pharma, agriculture, industrial bio. Right? We're not talking just healthcare. The many trillion-dollar sectors depend on bio. And historically, the exits have been by M&A to those leaders who are looking for the innovation and the technology to put into their commercialization. Part of why we started Genoa when we did is that we really believe that the impact of bio is now significant enough that more and more of these companies deserve to be freestanding, publicly traded. And so we're excited about those as well.
How do you distinguish between, or I guess, how does your background help you distinguish between something like AI hype and an actual piece of value?
Yeah, it's part of why we like to go very early, because you do have to have the expertise to look at the raw data. We read papers, we read grants, we look at posters at scientific conferences, and back to that sense of going to the fundamentals and not just believing the story is really important for making a distinction there. Yeah.
I'm just looking at your CV and listening to you talk. Are you from Georgia, or?
I spent a fair bit of time in Georgia. Yeah, my undergrad was at Georgia Tech. My family's still there.
Georgia, and then Yale, and now San Francisco.
Right.
What is it like in San Francisco right now?
San Francisco is a really unique geography. I moved there deliberately to find these kinds of companies because it's truly a melting pot for different kinds of science and technical disciplines, as well as different types of businesses, people from all over the world. And so you get this culture of really free-flowing ideas, a kind of yes and, let's try it, as opposed to, I would say, most other places in the world that tend to be a little bit closed, a little bit skeptical, which is healthy, but it's helpful in that laboratory to have a culture of trying things.
The venture capitalist that I interviewed last night, Michael Mignano from Lightspeed, he's New York, all in.
Weird.
He was like,
I thought
I'm not.
all VCs lived in San Francisco.
He said New York, but he does more consumer-facing companies. So
it makes sense in different spaces. Yeah, I mean, I love New York. I lived here for 3 years when I was at McKinsey, then moved to Boston, which is where I got into biotech, which I think suffers by comparison to New York. And so I spent a lot of time back here. It's the best city in the world. However,
thank you.
To do the work that I need to do for right now, that needs to be set up in San Francisco. And then I have the joy of coming back and visiting you.
Cool. Yeah. Well, we really appreciate it. I hope you come back.
Thanks.
Because it's fascinating stuff. Jenny Rooke, their founder and managing director at Genoa Ventures, talking to us about early stage, high growth investment.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, Matt Miller here in the Bloomberg Interactive Brokers Studio with Emily Grafeo. Carol and Tim are off today. I'm looking at a market, Emily, that continues to climb higher. The Dow Jones Industrial Average up to 44,236. Only reading that off the top of my WEI screen. But the S&P, it's only up 0.2%. However, it's up for the week. HCP space W shows me that the S&P is up 1.5% this week after a 2% drop last week.
And that was after a 4.6% rise the week before that, and then a 1.3% drop the week before that. So it has been a wild fall, Matt Miller.
Yeah, absolutely. But 59.60 is the level we're looking at now. So we're really only 40 points away from the big round 6,000 number. We pierced it, obviously, in the week after the election, but came right back down. Let's get over right now to George Young. He is a portfolio manager at Villere Funds. And George, let me get your take on just first the broader market here. There was a huge bout of optimism after Donald Trump won and Republicans took the House and the Senate. It seems to have calmed down a little bit, but we're still at very high levels. Do we continue going up into the end of the year?
I think we do. It's sort of a tale of two cities, however, because what you've seen in the past year or two has been the dominance of the Magnificent Seven. I'm sure all your listeners are keenly aware of that. But those of us who play in the small cap, mid cap world have not really seen those benefits. The Magnificent Seven has dominated things. The S&P is up 10% per year for each of the last 3 years. Small cap world, Russell 2000, basically been flat for 3 years. So all of a sudden in the last 6 months, and pronounced, especially in the last 10 days or so, we've seen more credibility and more viability in the small cap sector, which is great for us, those of us who are in there.
Tell us about the small cap thesis here, because you're right. We saw a big rally in small caps after the election. I write about ETFs, and there were a ton of people piling into ETFs that track small caps. So just a lot of money and I guess optimism here. But what is, I guess, the case here for buying small caps?
Well, the case here is that you want to buy what's cheap, and that's nothing new. You want to buy low and sell high. And you also don't want to fall in love with the stock. There's an old adage, don't fall in love with the stock, it won't love you back. Nonetheless, people have taken the Magnificent Seven, and I'll pick on NVIDIA in particular, which happens to be down today. People are saying things like, I'd never sell my NVIDIA. I love NVIDIA, that sort of thing. You can love grandma's pearl necklace that you inherited, but when it comes to a stock, don't fall in love with it. It's just not something that should be that emotional. It should be a very objective sort of game. You look at PE ratios, you look at any objective measures that will make a difference in what the market's going to do in the future. That's very important.
Talk to us about how you're thinking about the rise in Treasury yields, because that could also dent, I guess, small cap stocks, any stocks really, if we do see Treasury yields continue to climb. We're now over about, well, I can't pull it up, but about 4.4% on the 10-year right now.
Right. So the 10-year is very liquid. You're sticking your neck out a little far buying a 10-year, but that is sort of a proxy for the bond market. And remember that if you're going to buy a corporate bond, take a little bit more risk, you can get, let's call it a 5% yield right now in recognizable corporate names. So that's a very big challenge for the stock market. Bond market yields are attractive right now, in contrast to where they were 2 or 3 years ago, where you were buying 2% bonds, nothing to get excited about, but you wanted stability during COVID, and that made perfect sense. Now what's happened is the bond market is offering attractive yields. And it's interesting because, yes, you now know the election's over. We know who won. We know who controls the both houses of Congress. You know what the policies are likely to be. You don't quite know what the effect's going to be on the market. That's all good from a domestic standpoint, but the bond market, the U.S. bond market, is international in scope and has huge impacts worldwide. Everybody around the world trusts the U.S. Treasury market. So when you see yields going up, that means it's a higher bar for stocks. Stocks have to return more to get people to invest in them. So if the objective measures are there, then you want to buy what is compelling value. Right now, we see that in the small cap stocks.
I saw at one point last week, I think stocks and bonds were yielding just about the exact same thing. I have a chart with both of those two lines, and they collided. I was thinking, though, you'd probably be much smarter to invest in stocks over bonds if you had to pick one or the other going into Donald Trump's second term, because he's much more likely to be passing market-friendly policies. Does that make sense? That's something you agree with?
Not exactly. I'd say some people might be better off with stocks. Some people might be better off with bonds. Remember, there's a huge panoply of different investors out there. You've got the long-term trust fund baby, I'll say. You've got the widow that's got a limited amount of funds. So in terms of what's right for everybody, it's a little bit different. But universally, I'd say introduce some bonds into your portfolio right now, specifically some corporate bonds that have some liquidity, some Ginnie Maes, whatever it may be, something that can respond to this potential or likely, I'm going to say, rise in interest rates.
Versus U.S. stocks versus the rest of the world, MSCI ex-U.S., or versus bonds over a longer-term chart. I get it if you're a widow, if you're living on a fixed income, that's a different story. But for someone who's going to be invested for the medium to long term, is there really any reason to diversify? Don't you just buy U.S. stocks and make money?
Well, let's go back to the beginning of 2022. And if we'd made that statement at the beginning of 2022, the only safe place to hide that year was in cash or in gold. Stocks, terrible. Bonds, terrible. I don't care if you're short-term, long-term in bonds, you had your head handed to you. It was a tough year. I'm not saying that's going to happen again, but anytime anything looks like a certainty, that's when you need to be cautious about things. So I'd err on the side of a bit of caution. And I'd say to most listeners, yeah, take a few chips off the table and put some bonds in there. It makes sense.
We don't have a ton of time left, George, but I did want to ask you about Lineage. This is a company that owns 482 global cold storage warehouses. Why do you like to invest in that company?
Well, a couple things. We went to visit one of their facilities on Monday, so I feel like I know it pretty well. They have the state-of-the-art technology. They have a federal inspector in their office who houses there because they know how much shipment goes through their facility. Anything that you eat has to be maintained correctly. And they learned during COVID how to turn inventory and get food in and get out. Think chicken, think vegetables, et cetera. And these can be a light freeze, means it's still nice and healthy, but they dominate the landscape. They just went public in July. New company. It's based as a REIT, so it has a 2% yield right now that's being increased. So unlike most REITs, you can have your cake and eat it too. You get growth and you get income. I think it's a great company.
All right. George Young, partner and portfolio manager at Villere & Co. on Zoom from New Orleans. Thank you for joining us.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.